Today, my guest is Toija Beutler. Toija is the principal at Beutler Exchange Group LLC. And in just a minute, we're going to speak with her about facilitating a 1031 tax-deferred exchange. But first, a quick reminder, if you like the show, CREPN Radio, we would love to hear from you. You can like, you can share, you can subscribe. And as always, we love to receive your comments from all of our listeners. Also, if you'd like to see how attractive our guests are, you can check out our YouTube channel, and that's at Commercial Real Estate Pro Network on YouTube. With that, I want to welcome my guest, Toija. Welcome to CREPN Radio.
Thank you, Darren. It's my pleasure to be here today.
Well, I'm so delighted to have you, and I'm really looking forward to our chance to talk today. But before we get into the 1031 exchange, if you could share with the audience a little bit about your background.
Oh, sure. I am a real estate attorney, graduated in 1982, and I have to say that when I graduated out of law school, facilitating 1031 tax-deferred exchanges was not even a thing. It didn't exist. I never dreamt that I would find myself doing this work, which I have now since 1992. So what are we, 28 years, facilitating exchanges for individuals and taxpayers. Real estate attorney living in a tax world. And I'm not a tax attorney, but 1031, of course, is tax law. But having done this for nearly 30 years, we really have a handle on real estate law around 1031, tax law, business entities, estate planning, one thing and another that touches on 1031. So 30 years now doing really 1031 exchanges, nothing but.
Wow. So you mentioned that when you graduated, the 1031 was not even a thing. Is that right?
Well, 1031 was. In fact, this year is 1031 has been in the tax code 99 years. But back in 82, when I graduated law school, it was before we had regulation around 1031. And at that point in time, there wasn't the industry that I'm in now, which is these qualified intermediaries, exchange companies facilitating. So 1031's been around a great long while. Next year, we'll mark the centennial. We'll talk about why 1031's been around so long, but the work that I do did not exist at that time.
Gotcha. No, I'd love to hear a little bit about the history, because I think it's something that most real estate investors are familiar with the term, but I don't know that everybody understands what exactly it is, or the the details, or the the timelines or the mechanics of how it works. And so maybe a good place to start for the uninitiated is if you could just define what is a 1031 exchange.
Right. So Section 1031 of the Internal Revenue Code is applicable to investors that are selling three types of real estate. So what qualifies for 1031? Only three types of real estate. Residential rentals, that's the bulk of what we do. Single family rentals, duplexes, triplexes, things like that. So residential rental. Secondly, commercial properties, of course. And third, investment land, farmland, ag land, timberland, investment land. So if a taxpayer, I'll use the term, we don't generally use that. We prefer to call our clients exchangers. But the IRS term, of course, is if the taxpayer is selling rental or commercial or land held for investment, they got to pay their tax, right? Well, if they don't want to pay their tax, then they can undertake a 1031 exchange, go out and buy replacement real estate. 1031 is only for real estate. You're selling real estate, they've got to buy real estate. Well, the only good rule we have is the definition of like kind real estate. And the good news is my client selling residential doesn't have to stay in residential. They sell commercial, they don't have to stay in commercial. They sell land, they don't have to sell in land. Any of those three is like kind with any of those three. So it does enable them to buy replacement property that is dramatically different from what they've sold. But 1031 is an incentive program for folks that have their investment dollars in the American real estate economy, whether it's rental, commercial, or land, that will keep those dollars in the American real estate economy. then they don't pay tax. Otherwise, they're selling and paying tax. Well, if they do a 1031 exchange, the tax bill doesn't go away. It transfers over, is now sitting in the replacement property. So it's a tax deferral technique. They just don't pay the tax now. So it's an incentive program for folks who are in those types of real estate to stay in those types of real estate. And the reason it's been in the code 99 years is it's proven that it's good for the American real estate economy. That folks that are invested in those types of real estate, if they'll stay invested in that type of real estate, is just good for America in general to keep those dollars in that segment of the economy.
Gotcha. So what I think I heard, in the types of real estate you were defining, is it? I mean, it's primarily investment real estate, right? I mean, you wouldn't do this for
Truly,
a personal residence or something, but
truly.
something where you're generating income and have some sort of a probably a depreciation schedule, at least with the. I don't think you'd have that with farmland per se, but with any kind of a structure kind of thing, you'd have some depreciation. Although, if you have a property and deferring the tax, essentially what we're talking about is the gain. Is that?
Great question, actually. In most of our exchanges, there's a double tax savings. The gain in the old property transfers over, is now the gain in that new property. But you're right, depreciation. In its best form, when my client sells a depreciated rental single family and goes and buys a duplex, for instance, the depreciation schedule also moves over to the new property. So my client, in its best form, they won't pay tax on the gain out of the single family, nor will they have to recapture the depreciation, not now. So the gain is in the new property, the depreciation schedule is in the new property. You're right, land doesn't have depreciation. There's no depreciation going on there, but ag land, timberland is still investment and still qualifies, even though there's no depreciation activity there. But for most of my people, they're selling improved properties where there's gain and depreciation, and they will not have to recapture nor pay the tax on the gain if we can fully reinvest them into a replacement improved property.
Gotcha. You mentioned fully invest them in a property. What are some, I guess, parameters for, I don't know, you want to call it property A, the one you're selling, and moving to property B? Are there some basic rules of the road, or is there some common best practices? Or
Right. There's several rules. Of course, 1031 is tax law, so there's always a lot of rules under 1031. So let's talk about the financial parameters. Something that you will not hear me say other than right now, but you will see it in the common literature out there on the web about 1031, is that they have to buy equal or up. The taxpayer has to buy equal or up. That is not technically the answer. That's not the truth. And being an attorney, I kind of get technical on people sometimes. Can't help myself. So there's two financial criteria for a good 1031 exchange. The first being that my client utilize all of the cash sale proceeds, the net sale proceeds, toward purchase of the replacement property. Let's say hypothetically, they're selling for $1 million, pay off to a lender of 400, 600,000 of cash. Well, there won't be 600 of cash because there's commissions to brokers, title and escrow and recording fees, that comes off the top. So now our sale at $1 million, there's still the payoff to the lender of 400, but we don't have cash of 600. We only have cash of 550, hypothetically. Right. So it's to reinvest the net proceeds, 550. First, we reinvest the proceeds of 550. This is our starting point. Secondly, and I have to say the second rule is the one that catches people off guard most. The 550, they kind of understand about the need to reinvest the cash. But the second rule, having to do with that payoff to the lender, they need to go out and get replacement debt. Basic, go out and get replacement debt of 400, equal or greater. So now we've sold at $1 million. We reinvest the cash of 550. We go get new debt of 400. So we're targeting really not $1 million replacement value, but 950. So it's never $1 million. It's never equal or greater. We can net off cost of sale. So 950 for our replacement property value is our sweet spot. But I want to talk about the 400 to the lender, because when I explain to my client that it's not just reinvest the cash. They also need to get equal or greater replacement debt. Well, to be honest, that's when the shouting starts because, well, what do you mean? That wasn't my $400,000. That was the bank's money. And you show me where it says I have to go out and get new debt. I don't want new debt. And furthermore, I'll say that most of my clients are in their late 60s, 70s, and 80s. They've got all this game and they want to be debt free. And I do have to say that 1031 is not a way to get, it's not a good way to get debt free. So if I just take the 550 out and buy replacement property for 550 using the cash only, well, the IRS views that 400 payoff to the lender as debt relief to the taxpayer. And if they don't get the new mortgage of 400, basic rule, they're going to pay tax on $400,000 of debt relief, money that went to the bank, not to them. Well, why do they have to pay that tax? That makes no sense. Well, yes, it actually does. They were into the American real estate economy $950 after commissions and closing costs. So if they want the best result, they need to go back into the American real estate economy $950. And if they only want to go back into the American real estate economy $550, well, that's fine. But they've shorted America $400,000 and they're going to have to pay tax on it. So it's really, to get the best tax savings, it's probably they're coming in at $950 or somewhere right in there is the perfect solution. But I will say this, we do a lot of partial exchanges where they don't go back in at $950. Well, they want to take another $50,000 and run off to Paris. And so now we're down to $900. And so sometimes they want cash out for specific reasons, or they don't want a $950 property. They want an $850 property. Then we can buy it $850. But the target was $950. They'll pay tax on the $100 we fell short. So they were targeting a loan of $400, but only needed a loan of $350. They'll pay tax on debt relief of only $50,000. So we do a lot of partials where they do certainly never buy equal or up, and sometimes they'll come in under. And you know, hitting the $950 nail on the head is pretty nearly impossible. So they're going to be long, or they're going to be short. They'll still have a great exchange, though, in most cases. So the financial are the cash and the debt.
Got it. So I think that's really helpful to understand that it's not an exact match or greater. You can work with more or less, but just understanding that debt or the consequence of not matching, and then also just understanding that debt replacement. I think that's I don't know that I've heard that in all cases when I've talked with others. I think it's I think people have maybe breezed past that or not fully understood that.
They often just say equal or up, and that's glossing over it a little more than I'm inclined to do. But really, it's an incentive program. They've got $950 in the American economy after commissions and closing costs. Then to get the best result, they're going to keep $950 in the American economy. Gotcha. One thing I should mention, let's say, for instance, the payoff to the lender was only $50,000. They pretty much paid that property off. And my client says to me, I don't want a new loan for $50,000. And frankly, no lender will really do that anyway. Then alternative, if they don't want to pay tax on $50,000, cash added in. Instead of getting a new loan for $50,000, if they have cash of $50 and they throw that in the pot. So we're still buying at $950. $900 is the cash we're holding. $50,000 was the payoff to the lender. If we still go in and buy at $950, but using the cash that we held in the exchange account, plus any cash that our client independently throws in on the purchase, cash added in offsets the requirement for replacement debt.
Oh, so you can
alternative.
You can, I guess, replace that debt with cash if you choose to do so.
Exactly.
Okay.
So those are the financial parameters.
Gotcha. All right. So
we talk about deadlines.
Yeah, I was going to say timelines would be a good. Yeah.
Logically, that's the next thing to cover. Most important thing that people need to remember about the deadlines in 1031, they're carved in stone. There's no extension to these, no one-time extension. No, there's no extension. So here are what the deadlines are for 1031. And having been in this business long enough, I choose to be kind of a cranky old lady sometimes, and I've gotten judgmental. So I have my favorite deadline, and I have my least favorite deadline. And my favorite deadline is the 180-day deadline, and that When the sale of the relinquished property closes, my client gets 180 days to close on the replacement property. So it's nearly 6 months, not quite, it's 180 days, but nearly 6 months to close on the replacement property. So that is very doable. The only time we get into trouble on the 180 is if it's new construction and there are construction delays, weather delays of some sort. 180, this is a good deadline. Now the bad deadline, the client only gets the first 45 days of the 180 to identify. So when the sale closes 45 days later, 6 months, 6 weeks, 6 weeks, they have to identify the replacement property to their exchange company, us. And for most of our people, it's only 3 properties. 3 properties in 45 days. And they have to buy from that list. And that's why it's the bad deadline. 45 days, whether there's large inventory available out there in the market or small inventory. 45 days has never been enough time for them to find a quality, dependable, for sure, fire, good replacement property. It's too short, and only 3 on the list, and they have got to buy from that list. They cannot go off list and buy a 4th property. I will say, recently you had a client who identified 3, but then did not care for any of the 3 on the list. And one of them was in the area where there were the fires in California this fall. And they said, well, we don't like any of these, and can we identify something else? And we said, well, let's wait and see. The only way to get an extension of either of those deadlines is a federal disaster declaration. So you said, the fires had just happened. Let's wait and see if we can get a federal disaster declared here. Well, we looked back into it just 2 weeks ago. The client came back, and unfortunately or fortunately, whichever way you look at it, no, there have been no disaster declarations for the fires in California this last fall. There were the year before. Had there been a federal declaration, then we would have gotten extensions. But without a federal declaration, disaster declaration, carved in stone. So my client has what we know to be a failed exchange. They're not buying any of the 3. Carved in stone. That's the most important feature or understanding of these deadlines.
Wow. So the list is short and the timeline's short.
Yes.
And so even if there are 5 possibilities, you can only list 3. So you got to pick the best 3.
That's right. And I tell clients when we're first talking to them, between now and day 45, you can have 3 or 103 under consideration. But by day 45, they got to whittle it down to 3, and they have to buy from that list.
Okay. Well, I mean, at least that I would think, and maybe this is even a good next question, is just understanding when is a good time for somebody considering doing a 1031 exchange to get in touch with an accommodator like yourself.
And I would say, when is a good time to talk to us? When they have half a thought in their head about a 1031 exchange. It's never premature. And I know I'm going to have a conversation tomorrow where they're not expecting that sale to close for several years, but they're signing a letter of intent now. I'm going to guess they're selling to a developer. Those things take 2, 3, 4, 5 years before the developer's really ready to pull the trigger. It's not premature for us to be talking to them now. The sooner we're in touch with folks, the better. And although I and others in this office are attorneys, we are like other exchange companies that there are no billable hours for that time on the phone with us. Time with us is education. The sooner they start getting that education, open the lines of communication, the better they're able to plan and strategize for their 1031 exchange whenever it finally takes place. So a half a thought in their head is sufficient for us.
So what are some, I guess, questions that somebody should be asking when they come to you and say, Toija, we've got this property, we're wanting to sell, we'd like to exchange. What are some, things that they need to be aware of? I mean, we've talked about the timelines and the equal or greater property as far as a concept goes, but can you go through some of the, I guess, more of the entity that the property's titled in and
yes,
does that make sense?
Yeah, exactly. So frankly, when we get on the phone with folks about a potential exchange, First of all, we gather a little information about what it is they're wanting to sell, and then we quickly move over to, well, what do they want to buy? You know, it's real estate you're selling, you got to buy real estate. What do you want to buy? And we can buy almost anything the client wants as long as they'll follow certain rules, as like kind, residential, commercial land. So we can buy almost anything they want as long as they'll follow certain rules. Then after I get that overview, we start into a series of questions that we have here around some of the technical requirements. And you mentioned the ownership of the property being sold. So one of the basic rules of 1031 is this: the taxpayer that sells the relinquished property needs to be the taxpayer that buys the replacement. And that's not too difficult. Usually spousal, they're selling, the spouses will buy together, a trust sells, a trust will buy. But we need to explore that because oftentimes they're in some sort of a partnership, LLC, and they want to go their separate directions. They don't want to buy together. That's why I want to talk to them sooner rather than later to start to explore what solutions we have seen other clients utilize. And again, we're not their legal advisor. We can't tell them what to do, but we certainly can share with them what we've seen others do when they want to break up a partnership and go off in separate directions. So that ownership needs to match. If it doesn't, we want to detect that as soon as possible and start to strategize. Another example is my client is selling a property they own themselves. They would like to go in on a replacement property, bigger, better replacement property with another investor. How then do they purchase together? I still have to have my guy who's selling be the guy that buys, but how do we bring other investors in on that replacement property? So we have strategies and ideas, but you're right. The taxpayer that sells has to be the taxpayer that buys, and we're trying to strategize to get them to that result. We look at related parties. There are any number of rules prohibiting our client from buying from a related party. And we meet with the IRS every now and then. We did about a year ago. We meet with California Franchise Tax Board from time to time. And they have both told us in the last year that they are looking for related parties in 1031. And it's something that we always talk to folks about, is if they want to buy from a related party. And they can't. Basic rule is they can't. Once in a while we can find an exception, but not very often. And why can't they buy from a related party? I will just take a moment to explain that my client is doing a 1031. They're trying to find a duplex. They can't find a duplex. The broker hasn't been able to find the duplex that my client wants to buy. But my client's getting on the 45-day deadline, and they are not going to pay tax. They have got to find something to put on that list. And what they come up with as not their plan A, that was a duplex. Their plan B, my grandma. Oh my gosh, I know. Grandma, she'll sell me her house, and then grandma can stay there and be my tenant, and she'll pay me rent, and oh my gosh, I'm saved. So, well, they cannot buy from grandma. They can't. Well, why can't I buy from grandma? Well, because stepping back from that scenario, grandma is selling you her own home. She's not going to pay tax, at least on the first $250,000 of gain, so she's tax-free. And you're doing a 1031 exchange. So you're not going to pay tax either. And who lost? Who lost in that beautiful little scenario? Uncle Sam.
I say your number one partner, right?
That's right. And so 3 times a week, truthfully, 3 times a week, if my client could do that, they would, and Uncle Sam would lose 3 times a week in this office alone. So both the IRS and the California Franchise Tax Board, and I mention California only because we see a lot of California money moving up and down the coast, and we end up working with those clients, and we know what California is doing. And as goes California, so goes the west coast of the country, it seems. Everybody's looking over their border to see what California is doing. And so related parties, no, they cannot buy. Well, how would they know grandma has a different last name? Well, because on the 1030, when they report the 1031, there's a question. Did you engage in a related party transaction aside from the last names? My client has to disclose that they did. And there's been high-level case law in the last few years. So related parties, something that we look at very closely.
Gotcha.
Yes,
Let
please.
me ask you, there's two questions I want to ask you. On the related parties, is this an up-down relation too? I mean, could it be,
Oh,
is it,
thanks.
or is it left, right? I'm kind of curious on the brother, sister, mother, father's, grandma, up, down, or cousins, or is there,
Yeah,
is, how, how,
great.
how, how close and how far related, are we restricted?
Yeah, it's close. It's close. So it's really up, down, parents, grandparents, children, grandchildren, siblings. So it's not aunts and uncles, cousins, in-laws, ex-laws, outlaws. No, close. So we can buy from a cousin without question. And it's
Okay.
only buying from a related party, buying from the replacement property from a related party where we and enter into this issue and find this issue. Selling to a related party, not a problem. It's buying from the replacement property. There's the issue. So we do ask that question for sure.
Gotcha. I want to go back also. You mentioned on the ownership entities, uh, the buyer needs to be the same as the seller to um, protect the exchange. And you mentioned that you strategize on these scenarios. I'm just curious because I think one of the things that I've come to recognize, and I think that people, they get into real estate or they get into anything and not always thinking about the exit until they get
Oh,
close to the exit. And then, like you were saying, I own a property in either an entity or an individual, and now I want to join with others. Can you speak a little bit to some of the strategies that are possibilities, or things that you might discuss with um, the exchange participant on how to you know look at or possibly make that work?
right. So let me use an example of a client that's selling a residential rental and wants to join up with a buddy and go buy a strip mall. So they're selling the residential rental that they own in their name as an individual. But when they go to buy a strip mall, they're not inclined to buy a strip mall in their name as an individual. They and the other investor would like to form an LLC, limited liability company, for purposes of holding that new property. And the lender for the strip mall is expecting an LLC, the two of them inside of the LLC. Well, my guy sells an individual. If he buys as a member inside of an LLC, it's not a match. So one of our ideas is go back to the lender and arrange for each of the investors to form their own LLC. So we're still going to buy the strip mall inside of an LLC, two LLCs, one for my guy, one for the other guy that's coming in with cash. So two LLC borrower, buyer. And my guy who sold as an individual and buys as a single member of an LLC. A single member LLC is disregarded as far as the IRS is concerned. So whether my guy buys in his name as an individual, the strip mall, or buys inside of a single member LLC, his own LLC, one and the same, and that's a match. So we need, for financing purposes, to buy that strip mall in these two LLCs, tenant in common, our client and the other investor, two LLCs to buy that property. That works just fine. Another scenario I'll mention that comes up frequently enough, our client is selling a rental. They don't have any real need for these monies themselves. They don't particularly want more real estate, but they sure don't want to pay the tax bill. And they have a child, adult child, who maybe they could help out. They got this money coming out of a sale. They could perhaps go in with the adult child to help buy the child's new primary residence. And so we can have mom buy with daughter. Again, my client, let's say my client sold for $300,000. My client in a simple world needs to buy replacement property worth $300,000. If daughter found a $400,000 property to buy, my client needs to buy 300 of that in her name. Daughter can come in for the other 100,000. So daughter owns 1/4, mom owns 3/4. Tenant in common, the two on title together. Now, a couple of things to know about that. The good news is, if they need financing for the $400,000 house and daughter is going to be the tenant, they'll qualify for owner-occupied financing, which is the great interest rates and the down payment being what it is, but a great interest rate. So I love it when a family member is going to reside in the property and co-purchase with mom, and they get the great loan arrangement. Important to know, though, daughter's going to have to bring some cash to that closing. She can't just, and here's what they often do, is mom's going to bring $300,000 of cash perhaps, and the daughter will take care of the loan payment each month. Not good. Daughter has got to bring some cash to closing, and their percentage of ownership is reflective or a ratio of the cash down payment. So honestly, sometimes daughter only has 1% of the down payment or 10% of the down payment. If daughter's coming in with 10% down, then daughter only owns 10% of the property, mom owns 90%. It still works, both on title, great financing with owner occupied. Daughter does have to pay mom fair market rent for the 90% of the property that mom owns. So mom still has to have it on her books as rental. But we'll see oftentimes parent purchasing a property for that next generation, whether they co-own, that's most typically the situation. They're going to co-own. Now, you mentioned exit strategy. We can put them into this co-ownership like that, but you're right. They should be, even at that point, anticipating the exit, because someday daughter's going to want to relocate, daughter gives birth to triplets, whatever. At some point, we're going to have to come out of this again, but we can surely put them into something that helps out the family member, and mom doesn't really have to go out and have strangers living in a rental house and landlording like she once did. So various scenarios of how we might end up co-owning properties out of a 1031. And this is the kind of stuff we strategize all the time.
Got it. Question for you on the scenario with the mom and the daughter, as opposed to the one before with having grandma sell you their home. Does the reason why that one works is because it's a new purchase as opposed to buying grandma's house? I mean, you couldn't put grandma on the title with you in her house that she currently owns, could you?
No, we can't buy from, or we can buy with a related party,
Okay.
but we cannot buy from.
Gotcha.
Yeah.
Makes sense. Makes sense.
Now I have to say, my client says, well, grandma will have her just transfer the property over to her friend, and then I'll come in and buy from the friend. But
Yeah.
you can be sure, oh no, the IRS has all kinds of rules prohibiting that too. So
Yeah. Same
they
day
get pretty
closing.
creative with this sometimes.
Yeah. Creative financing, right?
Yes, that's right.
Yeah. So, all right. So we've talked about the tax deferral. We've talked about the types of properties. We've talked about the parties and kind of the timelines as far as when to start and the deadlines. Wonder if you could point to some things that you've seen that people have tried to do that have not worked, or maybe let me ask you this way: what are some tells that you would recognize if somebody, that it's not gonna qualify?
Great question. Although I said 1031 is for rental, commercial, and investment land, what does 1031 not work for? Second homes. So my client who's selling a second home, for instance, on the coast, and is done with the rain and the rust and the rot, wants to buy in Palm Springs. Well, 1031 is for rental. So that beach property cannot be a second home at the time of sale. So it has to be a rental. And then likewise, this Palm Springs property has to be a rental. And I would tell you about a third of our exchanges, our clients, that really, they don't want more real estate. They want a second home someplace, oftentimes in the sunshine. So in order to get them into 1031 eligibility, they have to stop using the beach property as a second home, convert it, if you will, to basically a rental, vacation rental. That's just fine. But the IRS did come up with guidance around that scenario, because 1031 is not for second home. It's for rental. So the IRS came up with some guidance that says there's a look back on the beach property, 24 months. And from the date of sale of the beach property, look back 24 months. And the client has to have had rental going on in there and very limited personal use to themselves. Basically, they could be at the beach house vacationing 14 days in the last 12 months, 14 days in the 12 months prior. Work days, we don't care, but it's vacation use. So this is a look back of 24 months. And then when we buy Palm Springs, that's a look forward of 24 months. So 1031 is not for second home, it's for rentals. And if they want to get a second home eligible for 1031, then there's guidance out there, and we can provide there's information on our website certainly about vacation rentals and this guidance from the IRS. So second homes, it doesn't work. Flips. So they buy a property to fix to sell. That's inventory. They bought it 3 months ago, they're fixing it up to sell, that's inventory and not eligible for 1031. Any more than new construction by a builder is, that's inventory. Lots created by a developer, those lots are inventory, that land doesn't qualify. I think those are the primary areas we get into. We hit a brick wall typically with second home, flips, and new construction. I want to mention mixed use. So 1031 is not for primary residences, your own home, like grandma, tax-free sale. However, question that we always ask clients is the property being sold or the property being purchased. Is there an expectation that this is a mixed use, a primary residence plus a rental unit, a primary residence plus a commercial building out back where the client has a landscape maintenance business, or their own home on 20 acres, one of which is a house and the other 9 acres are timberland. Mixed use, sale, their own home plus rental, their own home plus commercial, or their own home plus land. That portion that's rental, commercial, or land, we can do an exchange out of that. Not the house part, that's tax-free. But we can do an exchange out of that portion of the land that's in rental, commercial, or investment land mode, and then we can go buy replacement house. And we can buy the rental unit there, or the commercial building located on the site, or we can buy the land that's located there. So the fact that there's rental, commercial, or land associated with the primary residence, that portion can be utilized through and put it through a 1031 exchange. Mixed use properties, not uncommon for us.
Oh, that's interesting. I hadn't thought about that with like Timberland or something like that, where you have a residence on the property, but that
Right.
makes sense, I guess. I assume you have to, on your income tax returns, have to account for that accordingly. So is that.
Good point. Yeah, I mean, if they've got rental, they've got an ADU and there's been rental taking place there, then yes, that's right. They need to have shown that rental income, take their depreciation deductions, then it's eligible for 1031.
Gotcha. We've talked about kind of the go forward, a little bit about also like a partial exchange. Can you speak at all to the concept of a reverse exchange?
Oh, great question. And I just got off a call about a reverse. So what's a reverse? A reverse is when our client wants to buy something first, sell later. And so when does this happen? I've got one client, the one this afternoon, they're selling to a developer. Well, their sale won't close till June, but the wife has found a condo in Phoenix and she doesn't want to lose it. It's the perfect rental condo in Phoenix, and they want to buy, and they want to buy now. They can. The IRS will let them purchase the new property first, sell later, but what they won't let our client do, be the owner of both properties at the same time. So what happens is, and my clients are usually kind of dumbfounded by that, well, what happens is this. Oh, and I didn't even describe the forward exchange. Let me say, first of all, the forward. In a forward exchange, what is our company even doing here, besides talking, my favorite thing? In a forward exchange, our client is charged with preparing paperwork for their sale, in which we're pretending to sell that property, pretending. And then we prepare paperwork for the purchase, where we're pretending to buy that property. It's fiction. And that's all the IRS requires, is our paperwork in the closings, where there's this fiction created through our paperwork. In a reverse exchange, where they're buying first and selling later, we lose the fiction. So because your client can't be the owner of both properties at the same time, we end up being the temporary owner, usually of the new property that they're buying in Phoenix. We're happy to be the temporary owner, and truthfully, while we are the owner, we're going to lease it back to our client. They're going to have full control. If there's a tenant, they collect and keep the income. If there's a mortgage, they pay the mortgage. But there's two reasons why a reverse exchange is more daunting for our client. First of all, it's no fiction. We're the owner. The fees are higher. Typically in a residential transaction, our exchange fees, just so you know, On the sale, $850. On the purchase, $250. We're pretending to sell, pretending to buy, $1,100 all in. Well, if we have to buy and be the owner of the place in Phoenix, we own, it's not $250 to buy that. Our company alone, our fee is $6,000 to be the temporary owner. And, you know, that property goes on our books and my accountant has to report it on our tax return, and they're expensive, and we set up LLCs and on and on and on. The complexity of us being the temporary owner of that property. So they're quite a bit more expensive, number one. Secondly, not too difficult in this current market, but secondly, we can only own the Phoenix property 180 days.
Oh,
So whether
okay.
it's a forward or reverse, it's the same deadlines.
Same 180 days to get
Yes.
that completed. Okay, and I
That's right.
appreciate
That's
you sharing
right.
it. And also, you were mentioning, and I didn't mean to run past this, but
Mhm.
the work that you do as a qualified intermediary.
Mhm.
I mean, you meet with people, and can you explain a little bit about how you interact with title and to try and keep everything segregated so it doesn't get what is the the phrase constructive receipt
Oh,
or
yes. Oops.
yeah.
Exactly. So while most of our day is spent on the phone consulting, and I will use the word, but no charges here, that's just education. So most of our day is, and when they have half a thought in their head, can I do this? Can I do that? What have you seen? Yeah, on and on and on. Most of our day is just spent talking and offering up ideas to folks. But what they need us for is our paperwork in the closing, where, as I said, we're pretending to sell. So once we've communicated with the client, largely over the phone, if they have the time and want to come to the office, they certainly may, although we've got a client in Spain right now, and she's not going to come to the office while we hash this out. So it's mostly over the phone. Once we've had a good foundational conversation with the client, then our job, and what we call most of our staff in here, are coordinators. We coordinate with the title company to get our paperwork into that closing, to create this paperwork fiction. And in our paperwork, there will be the instruction for the title company, oh my gosh, to send the money to us, not to the client. So we've got to get our paperwork in there so that we step into their shoes as a seller so that the money comes here. Then once our client alerts us to where they're buying, we get paperwork into that closing too. And our work is all over the country every day. There is really no geographic restrictions on us. So I've got a farm sale in Kansas that's going to close here in a few weeks. Selling in Kansas, going to buy in the local market. It's just wherever in the country our client is selling or buying. But it's our paperwork in those closings, and the client won't sign anything of ours until closing. Only if and when it closes do we then earn these fees. And the money
Gotcha.
comes here. There's really two jobs here. We have to do this paperwork and we have to hold their money until the purchase is ready to go. So that's our technical job as dictated by the IRS.
Gotcha. And along the lines of your job as a qualified intermediary, what are some things that somebody that's considering doing an exchange should look for in an exchange facilitator?
Good question. Well, first of all, because it's tax law and real estate law, they need an exchange company that will hold those conversations with them. Yes, all of us in this industry tell our client to go to their accountant, go to their attorney for these answers. But honestly, the accountants and attorneys don't live, breathe, and dream about 1031. It's sad to say, we dream about it at night. So uh, they need somebody like us who will discuss with them what it is their goals are, what they're trying to achieve. Half of the calls that we get in here won't turn into a 1031, because once we've had that conversation, 1031 is not the best way to get them to the dream. So they need somebody that will hold that kind of a thorough conversation with them, issue spot, strategize, not as an advisor, but simply as, well, we have the experience. Also, they need to look at exchange companies in terms of bonding, errors and omissions. Oregon has requirements for that. Washington, California. Well, anybody practicing in these three states really does meet those bonding and errors and omissions criteria. I think that what is important to our people is 1031 is kind of a local business. People look to the local company, local processing. They can walk through the door. So There are national companies that process remotely, and that, works, but a lot of our clients really want the local hand holding. So the responsiveness and folks that will get on the phone, they're trying to write an offer for replacement property on the hood of the car. They need a fast answer. So
Right.
they need a company that will be responsive in that way. Our fees tend to be pretty close to one another. We've got to be competitive, $100 or $200 apart usually on the fees. So they just need the customer service.
Got it. Got it. Toya, you've just been packed with information on a 1031. I love it. This is great. If we could, I'd like to shift gears. And as I mentioned you before we started, by day I'm an insurance broker, and
Mhm.
in as much we do risk management with our clients. And there's three strategies that we typically consider for risk management. And the first is, can we avoid the risk? The second is, if we can't avoid it, can we minimize the risk? And then if neither of those are options, can we transfer the risk? And that's what an insurance policy is. And I like to ask my guests a question about what they consider to be the biggest risk. And so if you're willing to play along, and also want to reiterate, I'm not necessarily looking for an insurance related answer, but I'd like to ask you, Toija Beutler, what is the biggest risk?
So I'll give you the saddest phone call we get in this office. My sale closed yesterday. I want to do a 1031 exchange. So the biggest risk is not talking to an exchange company, and they get fixated on the 45-day deadline, which, as I said, is the worst deadline. But the biggest risk and the worst case scenario is they don't talk to a 1031 exchange. They've been on the internet. They've read all about it. They have it all figured out. And they've got the 45 days. And they call us after the sale has closed. We cannot fix that. We cannot fix that. And so the biggest risk is not being willing to talk to an exchange company as part of their due diligence. And I will say again, like, there's 3 attorneys in here, and they don't want to talk to us because they're afraid there's billable hours, which there isn't, but they're afraid there are. And so they won't not call us and engage us, and don't want to bother us, and they don't want to take up too much of our time, and they won't talk. And then by the time that we end up talking to them, the sale has either closed or they're so far down the wrong path, we can't fix it. So I go back to my original statement that when they have half a thought in their head, they don't even know the words to put together in a sentence, what questions even to ask us. We have the questions. We'll ask the questions. So the sooner they talk to us, the better they'll understand the path. Now, when they talk to us, that conversation can go 15, 30, 45 minutes, a few weeks, days, and years sometimes. But the sooner they're in line of communication with us, the sooner we can keep them on the path, and we'll keep talking and talking and talking until they have found the path that gets them to whatever their rainbow is. And so not talking to the exchange company, and sometimes they're in a situation I can't fix. So the sooner they're talking, and certainly well before closing.
So no DIY exchange, huh?
You know what? You will not see that on the DIY network. No, you won't.
uh, that's great.
Nope, they got to have, why do they have to have us? And the question, I've had it several times in the last few weeks, well, do I have to have you? Well, as a matter of fact, you do. Well, why? It's just the rule.
Huh?
Lame answer, but it is just the rule. They have to have us prior to closing. Yeah.
No, that's good.
Yeah.
Well, Toya, this has been packed full of information, and you've been just a pleasure. I really enjoyed talking with you, and hearing you talk about how these things work, and the ins and outs. Before we wrap up, where can the listeners go if they'd like to connect or learn more?
Well, we do have on our website a pretty good 1031 library. So that's www.BeutlerExchangeGroup.com. So Darren, I hope you can put that up for folks. Beutler, B as in boy, E-U, T as in Tom, L-E-R. BeutlerExchangeGroup.com, and there's a 1031 library there. May I also point out, on the website under tools, they will find a checklist of what they have to do to have a good exchange. We think that's really one of the best things. About 3.5 pages. So it might look daunting, but it's really just the mechanics. Step 1, step 2, step 3 is talking to us, and on down the line of what they have to do to have a good exchange. So it's a nice roadmap. It does not replace the conversation, but it's a good starting point if they're exploring 1031.
Well, that's great. Yeah, and I'll have all that in the show notes there. So anybody
Great.
is not able to write down, you can go check out the show notes. Well, Toija, I cannot say thanks enough for taking the time. I've enjoyed talking, learned a lot, and hope we can do it again soon.
I'm here for you. Thanks, everybody. Thanks,
All right.
Darren.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.